Good afternoon. It is April the 23rd. It is noontime exactly. This is Dave Clayman, CEO of 12 Points. Looks like we're waiting for a few more attendees to join us, so we're going to get started here in about 2 minutes. We will talk to you soon. Thanks. All right, well, good afternoon. It looks like some others have joined us now, so we're going to get started. We'll let the stragglers join us later. So, hi, I'm Dave Clayman, CEO of 12 Points. I'm joined by Jeff Rolk from Gold Coast Mortgage. We're going to talk today about buying and selling a home, the process simplified. So it's about that time of year, so let's take a look at what that entails. So as I mentioned, I'm Dave Clayman. Some of you may have met me when I'm out visiting with your companies as co-founder and principal and 401k advisor of 12 Points. And this is just our general monthly education on different topics that might interest you besides your 401k. And Jeff, I'll let you talk a little bit about your background.
Yeah, thanks, Dave. My name is Jeff Rolk. I'm an advisor at Gold Coast Mortgage Services. We're a small independent broker. We're located in Beverly, Massachusetts, and we're licensed in Massachusetts, Maine, and New Hampshire. 20th birthday is April 27th, so we're coming up on 20 years as an independent mortgage broker in the industry.
Congratulations. And one thing I can tell all of you, the advice here, of course, is independent, and you can take it anywhere, but if you're looking for unbelievable service, Jeff has been an unbelievable resource to our clients, head and shoulders above anyone else I've ever met. So
thank you, Dave.
So what we're going to cover today, so we're going to cover affordability, what the mortgage process looks like, because it can be scary when you got to put all those documents together, tools and resources that you can get either online or through people like Jeff, costs, and what timing looks like, how long is it actually going to take you to get through this process. So how much house can you afford? So one of the first things that mystifies people is, oh my goodness, what is my credit score? I don't know. I've had, you know, I don't know if I've got an 850. Is that good? Is that on a scale of 1,000? Is that on a scale of 500? What is that? So, you know, they do range from 300 to 850.
Mm-hmm.
And I'll let Jeff talk a little bit about what they're looking for in terms of a credit score.
Yeah, so one of the main misunderstandings that starts involving credit is when a client gets their own credit score. And maybe your credit card has a FICO score available, and it's one of the bureaus, and it's kind of a generic score. But depending on who looks at your credit, you have about 200 or more different credit score calculations. So if you were to apply to finance a piece of furniture, or try to lease a car, or secure a mortgage, or you're getting a background check to rent an apartment, you have different credit scores depending on who pulls the score. So one of the first tactics is to make sure that you have your score pulled specific to securing a mortgage. Otherwise, it'll be inaccurate. People can have a score of over an 800 at a car dealership and a score in the 600s at a mortgage company, and the opposite can be true. So, and credit plays over a 30-year loan or a lifetime of lending, it can be a six-figure difference in money that you've spent. So the real strategy with credit is to engage in that 12 months or more before you're actually going to try and secure a mortgage, because you can iron out some issues. You can possibly make changes that will reflect in your credit score by the time that you go live and try to actually get that mortgage.
Talk to me a little bit about how inquiries affect your mortgage score, because everyone's always afraid, oh no, I can't go look.
That's a misnomer as well in the mortgage industry. So if I pulled a client's credit on Friday and then pulled it again on Monday, it would be identical. We're registered with the credit bureaus as a mortgage company, and it stipulates in a pre-qualification or a pre-approval letter that your credit's been reviewed, and then that credit has an expiration date. So if we exceed that expiration date, we have to pull credit again. If you have a Credit Karma or one of the watchdog apps, I've seen clients get an email saying your credit score just dropped like 90 points because Gold Coast Mortgage looked at your credit. And that's inaccurate as far as your true FICO scores at the credit bureaus. Depending, other uses of credits can move it up and down by a few points, but because the way the mortgage tier system works, if I pulled it and you were 741 and that took you down to a 738, that could change how much you pay a month, and that would be an unfair practice for the credit bureaus. So we won't affect your score, and it's necessary to look at ahead of time.
Okay. One of the other things that comes up is, how do I estimate the annual cost of home ownership? So I go get a mortgage and, hey, it looks like I can afford my mortgage. But, oh, geez, I didn't think about my tax bill, utilities, insurance, maintenance, all that plays into it. You have an estimate of what percentage people spend on those other things?
Yeah, so principal, interest, taxes, and insurance are the four main pieces of a mortgage payment. So you have your principal and interest, which is just calculated based on the loan and the interest rate. Taxes go generally into an escrow account. So if you're looking at a home, they'll have the taxes annualized online or on the listing. You divide that by 12, add that to the principal and interest. And then we usually use a placeholder of $100 a month for homeowners insurance. That's comfortable in the New England area, but that can vary from state to state and different parts of the country. So make sure it should be able to get a really quick free estimate from any homeowners insurance, just to make sure that that's a comfortable number. And that's going to be what to be aware of. If you're buying into a homeowners association, also be aware of homeowners association fees, HOA, or also called a condo fee, which would pay for the master insurance policy and then any amenities that your neighborhood association or your homeowners association has. A reflection of that is usually lower homeowners insurance because you're paying for a different insurance policy already, but you just want to be aware of all those different costs that add up into your true monthly payment.
And then as far as utilities, you can ask the prior homeowner for copies of bills?
Absolutely. So what are they paying a month? And, it's usually kind of a going rate for the neighborhood if the house is efficient or not. And that's all stuff that can also come up with your home inspector. They'll tell you what to kind of expect as far as efficiency with the heating and the cooling systems. It's all very individual to the house. There's a lot of brand new homes and there's a lot of 400-year-old houses in New England particularly. So you run into everything from really, really efficient to absolutely no insulation whatsoever. And then on the maintenance side, the same home inspectors will tell you just count on using about 3% of your home's value each year put back into the house. And some years you'll spend lower than that, and some years if you paint it, you're going to spend more than that. But that's a good rule of thumb for maintaining your home and expenses associated with it.
Which, if you think about in New England, that's about $15,000 a year, so probably another $1,200 a month to be thinking about.
Yeah.
So, the mortgage process and decision points. So, one of the first things to think about is mortgage term. Also, how much you're going to put down, which will affect what whether you have to pay PMI, mortgage insurance. Fixed rate versus variable rate, and do I want to pay points? So Jeff and I are going to have a little back and forth here because I think we're going to have a small disagreement on fixed versus variable, but it's good for you to get both sides of the argument, I think. So I know that the average person stays in their home for 7 years. So I'm a fan of the 7-year ARM if you don't think you're 7-year adjustable rate mortgage, if you don't think you're buying your forever home. If you think you're buying your forever home, different story. Then you want to, then you're looking at a fixed rate, I think, almost always. in terms of if you're only going to be there 7 years, which is that, again, that average home ownership for any given time, then it's more likely that that adjustable rate might work out for you. As far as down payment, boy, it's tough these days to see 20%. You know, home prices have escalated so much more than incomes, and so many people have more debt. But obviously that 20% is kind of that gold standard of where you get to, or maybe your Gold Coast standard in this case. If you could, you know, I think we like to see at least 10. I'll let Jeff touch on that a little bit more. And then points, I could be convinced either way on that. So Jeff, you're.
Yeah, so mortgage term, I'm a fan of the 30-year loan because it is the lowest required payment. No reputable lender out there is going to charge a prepayment fee. So if you take a 30-year loan and make a 15-year payment, you'll pay that house off in like 15 years and 6 months or something. But if in 5 years you have a need to change your financial picture, you have the option to make that lower payment, and that's at your discretion. You don't need to apply, you don't need to pay for closing costs, you don't need to secure a new interest rate to accomplish that. If you took a 15-year loan and then you wanted the 30-year payment, that would require a refinance, and that comes with closing costs, and that also engages whatever rates are in the future, and that's the unknown. And that's my argument every time for fixed versus variable is what are rates and what is the housing market and what is the job market going to be 7 years from now? Nobody has any idea. And if you happen to end up somehow underwater in a house or home prices have skyrocketed and you can't make that purchase, and we happen to be in a higher interest rate environment, that 7-year correction is going to come and you might be unable to move. You might be between jobs. You might have gone to self-employment and you're not qualified for 2 more years. And all those savings between the adjustable rate and the fixed can be undone in a single payment cycle after that adjustment. So if rates go down and we can do a no points, no cost refinance, then you capture lower rates. And if rates go up, you sleep really well at night, and you're happy knowing that you don't have to participate in the rising interest rate environment. And that way, if you keep your house for 10 years instead of 7, I'm at over 8 in my house. And we've refinanced as the market went down. And, you know, if we go and purchase a new house, we're just going to have to engage in whatever the rates are that day. And then paying points, it's hard to recoup your money on that. You have a date that you factually have to keep your house until to recoup any points paid. So paying points buys a lower interest rate. So if you like
what is a point, Jeff? I'm sorry.
Yeah, a point is 1% of your loan amount. So on a $500,000 loan, a point is $5,000. And let's suppose that $5,000 got you an eighth in rate. So you pay a point and you get 1/8 lower interest rate. You have to make up that $5,000 at around $20 a month. So there's a time that you have to stay in your home.
So remember that 7-year average? You just got to 20 years on that number.
Yeah.
So hard to make up those points.
It is. So I'm a big fan of the no points loan, which is the lowest rate you can get without paying any additional money. And there's a break point usually built into rates by the lenders that sets that at a reasonable number. And then if a client needed some money to cover the closing costs, you can go the opposite. You can be paid points. So if you had a rate of 4.25% and you said, well, I'll accept the $20 more a month to go to 4.375, the lender will then pay you some points. So on $500,000, a whole point would be $5,000. That should cover all of your closing and most of the escrow account. So you can maneuver it either way, and it's at the client's need. If it's a cash flow problem, it can be taken care of as far as if you want to divert all your money to down payment and you're okay with that little higher a month payment. And again, there's a break point in there where eventually you are going to pay more, but does it get you into the home of your dreams at the time? And then is it something that you're willing to accept?
And to me, that's the big difference of having an advisor as opposed to just going to a bank, because they're trying to get on to the next transaction. They're trying to get done. And I think that high level of service, whether it's Jeff or somebody else, that can be a very valuable resource for you. My own personal story, real briefly, when I bought my first house, it was a multifamily. I did the 7-1 ARM. I got out of there in 6 years. That worked out well. Currently I'm in my forever home, so I got the 30-year fixed. I'm not gonna lie, I did that. So I have never paid a point though. I bought 3 houses and never paid a point, so.
And a great example for the fixed versus variable is what if you decided to keep that multifamily and rent it out?
Yep.
And now it's in, how much rent are you going to get a month if the rate's changing on you, or you have it stabilized in a fixed loan and now you can count on the rent versus the payment every month when you go off and secure your next house.
Yep. So great tools. I'm a big fan of mortgagecalculator.org. It's a very quick way to see how much is my payment going to be. So you can go right there, fill it out online, and it gives you a nice quick calculation. As far as affordability, I know lenders will go much higher these days. I'm old school. I like to see your home payment not be more than 28% of your total gross monthly income. So if you're making $10,000 a month, $2,800 a month as your home payment. Your total debt, I like to see under 32%. Because if you think about it, if that's your gross, if you're in the 40% tax bracket, let's say, 40% to taxes, 32% to your total debt, that's 72. Now we're at 28%. We got to eat still, we got to drive, we got to pay, we got to do all the things we do to live, and maybe we'd actually like to save a couple bucks. So I know I hear stories of lenders lending out 40%, 50%. That's awful tough when you think about your tax bracket. So now you borrow 45%, you're in a 40% tax bracket, you're at 85%. Well, now you got 15% to eat and live and breathe and do everything else you want to do. So, you're on Cumberland Farms coffee for sure, not Starbucks. I'll say that at the least. So.
Yeah. So your combined monthly debt is the qualification number. So your credit cards, student loans, car payments, anything that's on your credit as a payment goes into your mortgage calculation before you start qualifying for a loan. So if you max out at 50% of your income for round numbers, and you already have a $2,000 a month payment on that $10,000 a month, now you're limited to that $3,000 remaining. So if somebody has no debt, they can go higher, but that self-instituted cap of 28% is that's a comfortable number. And then it's going to depend on, is there other income that's not going into that calculation that makes people more comfortable? Occasionally, someone will have a second job. Somebody will have a spouse that's not qualifying on the loan, but they are working. Other household income, rental income, So there's compensating factors, but the maximum amount you can use to qualify is pretty set in stone, and that's between 40 on a jumbo loan. You can't exceed 40% of your total income with debt, and up to 45 to 50% on the smaller conventional loans.
Professionals. So you got a lot of people. You got lenders, you got mortgage brokers, you got lawyers. Jeff, tell us a little bit the difference between a lender and a mortgage broker.
Yeah, so the lender works directly for the institution that is making the loan, and they have the products that are available at that institution. So there are banks, there are credit unions, there are direct mortgage companies, there are other small institutions that work to secure your mortgage, all the way up to the massive companies like Quicken Loans. And they're out there selling the same product as everybody else, and it's just a different version of it. The broker platform that my company's on allows us to contract with usually about half a dozen of those companies, and each one's chosen as a front runner in one product usually. So the lender that we use for conventional lending and the jumbo lending, their 30-year fixed is a phenomenal product, but they don't have any government products. So if somebody's a veteran, the Veterans Administration loan is unbelievable with the benefits that it comes with. And we have a lender that's got a phenomenal VA product. They also have a jumbo loan, but it's not necessarily competitive with our other lender. And the broker platform allows us to pivot back and forth depending on the need of the client.
So, and then lawyers, yes, you do want a real estate attorney working for you.
In Massachusetts, it's required that an attorney do the closing. And cost-effective wise, just make sure that they're a real estate attorney. There's mistakes that can be made. There are things that can be missed that are just very run-of-the-mill to them. It's the same as a doctor versus a specialist. You want to go to the specialist to secure the house that you're going to live in. Cost-wise, they're all relatively within a tolerance the same price. So you just want to have somebody that's comfortable in the area that you're purchasing in, and recommendations from your mortgage person or from your realtor should lead you in the right direction. If you're calling yourself a real estate attorney, people probably know you for your follow through. So just go off of the online reviews. Google reviews are really good because those are written by real people. So if somebody's got positive reviews about them, it's a pretty good sign.
And then property insurance, you're required to have property insurance?
Yeah, to secure a mortgage, you have to insure the property. And, again, you can take a recommendation. You can look online for people with good reviews on platforms that can't be paid for. So, Zillow.com is kind of the evil empire, and you can buy your way into a 5-star there. Google.com, if you Googled, a mortgage firm or an insurance company, it's really hard to fabricate those. Google cleans them out if they think that they are fabricated, so pay attention to that.
So working with a real estate agent, so a couple things to be aware of. Be aware of whether you have a buyer's agent, or when you if you go into an open house and there's an agent there, they're working for the seller.
Mm-hmm.
So be mindful of whether they're working in your best interest or in the seller's best interest.
Yeah, and thing to remember is the seller pays both real estate agents. So for you to hire a buyer's agent is no additional cost for you on a purchase. A seller's agent generally charges 4 to 6% of the sale price, and that split goes out to the buyer's agent for bringing the buyer as well. So for you to go in unarmed or to go in with an agent with you, there's no additional cost. So you've got somebody who, again, filter through the reviews, find somebody who is known to work in the community you're buying in, because their name will carry some weight. If somebody sees a name that they see all the time who's active, they would anticipate a deal that's going to go through. If somebody sees a name that they've never heard of, occasionally they would choose a more local person over that because they're reputable. So it's a good strategy to have somebody that you're comfortable with and you also believe is a successful person in that area.
And that can make a huge difference if it's a house, especially. I know we had a lot of bidding wars last year. I'm not as up this year, but if you're walking into a bidding war, or someone you might be $5,000 or $10,000 higher, but if that agent's telling his client or her client, hey, this deal is actually going to get done, even though there's a little less money in it, you should take this deal. That buyer's agent can really be helpful for you. So I would strongly advise you to have a buyer's agent. How much cash should I plan on coming up with before the transaction's complete?
Yeah,
aren't these free? No?
Yeah, totally. So you got to decide your down payment, and that's at the discretion of the client, and they will, if they have one available, talk to their wealth advisor. It's a substantial amount of money, but the down payment is going into equity, so it still exists as on like a balance sheet as your money. It's just tied up in secured inside of a home. And then less than a 20% down payment triggers the mortgage insurance that we talked about a little earlier. And that's another thing that is designed around your credit and your income and how much of the house you're financing. So somebody who has only 5% to put down, but an exceptional credit score and income that's healthy, you're going to get more favorable mortgage insurance terms, and it's actually fairly tolerable. If you start checking some more boxes and credit's an issue, or you're lower than the 740, or you're lower than 700, and you're only going to put the 5% down, now the mortgage insurance, the risk goes up according to the actuaries, and therefore the mortgage insurance premium goes up. So there's breakpoints in there where it's a very acceptable number if you have all the ducks in a row, and that goes back to 12 months in advance. It's really not a bad idea to just go on a dry run and see what mortgage insurance will cost. And you say, well, we need a savings campaign to get rid of that, or we're okay with that. Let's rock. The house of our dreams might come up on the market next week. Other than that, you'd want to have your closing costs. In Massachusetts, it's around $2,500 to $3,000 to close. And then you want to have in reserve 6 months of the taxes. It's the most that can go into your escrow account. And you're going to pay your whole first year of your homeowner's insurance up front. So maybe $1,400 instead of the $100 a month, but just have all those numbers, in excess when you go to close or go to make your offer.
So we talked about an attorney being required in the state of Massachusetts, even if you're not in the state of Massachusetts, as obviously some of our clients are not.
Yeah.
I would advise having an attorney there to get the closing done.
Absolutely. So you've got somebody who regularly reviews purchase and sale agreements. Though it's not ideal, all the time there's a reason to pull out of a purchase, and you need somebody making sure that your deposit that they've already collected is safe and it's going to be returned to you promptly. You need somebody making sure that the sellers are going to follow through on all the stipulations of their side of the sale. Sometimes they'll write into it that, yes, we're going to resurface the driveway, and then, you know, game day, maybe it hasn't happened. That attorney can engineer a situation where the seller has to follow through for you, and that's their job. And they also have the ability to litigate. They're an attorney. So that brings a level of professionalism to the purchaser's side that protects them and helps move the deal more smoothly. So it's never a bad idea to have a true real estate attorney in your corner.
And as far as just like any other advisor, when should I bring them into the process? As early as possible.
Yeah, I love introducing people to an attorney way early into the deal, because maybe they call me with a question and I say, it's a great question for your attorney, and they've already met them. And then it's a much easier, you know, I can write the email and just ask. But you want to meet the team and you want to be aware of who they are before game day, that's for sure.
Home inspections and repair estimates. So I can tell you I'm a big fan of the home inspection. I know, again, in these tight times, a lot of people have waived home inspections and given that right away in order to get their offer accepted. Unless it's even if it's a brand new house, I'm not sure I'm a fan of that, but
yeah.
Especially not in an existing home, I'm not a fan of giving away your right to a home inspection.
Yeah, it frightens me. So your home inspection's $500 to $700. You know, it really depends on the square footage of the house. So if it's an enormous house, the home inspection will cost more and take longer, but it's the best money you're going to spend. That's not always obvious to the naked eye what the problem in a house is. And the home inspector, they work in a territory. They're comfortable with the types of homes, the types of foundations, the way that houses used to be built. So they know the types of repairs that people made. So like the holes drilled in a driveway every 2 feet are actually termite repair. And I learned that at a home inspection. And they said, okay, there's no chance this house has not had termites, because no one would have done this otherwise. So then they can much more stringently go look for termite damage and termite repair. And if that kills the purchase, it's the best $500 you've ever spent, because you didn't spend hundreds of thousands of dollars on a house that is in need of, you know, imminent repair. And that's a really good thing. So one way around the contingency of a home inspection is bring your home inspector to the open house and, you know, just do a guerrilla inspection while it's open. They can look around in the basement, and, you know, it's not going to be checking every single outlet. You know, we're not going to get to the $50 problems, but are there any $100,000 problems, $25,000 problems? You know, is the plumbing not up to code? They can visually inspect all of that. And then you can confidently say, yes, I'll waive home inspection, because you're aware of what issues there are or aren't in the home. And we've seen people use that strategy very successfully.
It's a great tip I haven't actually heard before. And then repair estimates, you know, to Jeff's problem, to Jeff's point, excuse me, you're not worried about the $50 or $100 problem. You're worried about the $50 or $100,000 problem. I can tell you, when I bought my home, it's built in 1760. I had a guy come out, and he was concerned because the house was sitting, the sills were 2 by 4, and they're supposed to be 4 by 8 or whatever. I'm not construction inclined, but anyway, he had me call in a colonial expert to make sure on the house. And I said, look, I need to know one thing: is it fallen or is it falling? Because fallen and stable I can live with. Falling I have a problem with. So after much debate, they did decide that it was fallen, and 6 or 7 years later, I can tell you they were correct. It is the case. But it was a concern, and it was worth looking into and discovering. And I've also had a home deal blow up because of what was hidden in there. So
yeah, and it's you know, at the end of the day, it hurts at the time, but in the future, when you live somewhere else that doesn't have that problem, or you drive down that street and see that house, you know, getting excavated around it to do the repairs, you didn't purchase that issue, you didn't purchase that expense. So people get mad, but it's a victory to find out you shouldn't buy a home.
It sure is. Seasonality of the housing market and optimal times to buy and sell.
Yeah, so the spring market is in full swing at the moment, and factually, every single day in Massachusetts, June 30th will be the busiest day of the year at any registry of deeds in any county, and that is mainly driven by the school year. So most families want to be a resident of a specific town by June 30th, and then there's less extra steps to go through to get your family into that school system. And people who are single, people who are empty nesters, people who don't have kids yet, people who are purchasing for other reasons than that or within their own town, after the spring market, there tends to be a little relax and some houses trickle back onto the market. So the best time to buy is when you find the home you love. There isn't an ideal time. There's no last day of the month or anything like that. That's the day to do it. It's really that your offer gets accepted on a house that you want to live in and you're comfortable with that price. So there's other factors like a new job that might make you willing to pay a little bit more for a house because you have to move and you don't want to commute. But all of that is case by case.
And then optimal times to sell. Well, it's nice to be a seller at that time when everyone's looking to buy.
It sure is. And again, you don't always have the choice of when you sell. You might be moving to that new job, and just market the house correctly. And the ideal situation is that you can divide it into two separate transactions, and that's not always possible. Other than that, you have the simultaneous buy and sell, which is nothing to be afraid of. But you just have to have a few more ducks in a row at the exact moment, because one morning you're going to sell your house, you're going to collect that money, and then that afternoon you're going to purchase a house. So we need a buyer that is in line to make that purchase from you, and you need a seller that's in line to make the sale to you. So again, it's the strength of the team around you to keep everything on track, and if anything changes within that deal, they'll keep it together. So if the sellers can't sell to you for 2 more days, we need to renegotiate with your buyer, because you can't be homeless, and you do need to close on the house. So there's always a solution, as long as people stay calm and just take good care of that actual need. The goal in mind is to own the new home.
So as you all know, we're here to help in any way we can financially. So you know me, Dave Clayman, so dave@12pointswealth.com, or you could be familiar with my partner, Francesca, also francesca@12pointswealth.com. There's the phone number on the screen there, 978-318-9500. And again, Jeff is an awesome resource if you're here in New England. If you're not, reach out to us. We can help you try to find someone somewhere else. And Jeff may even know someone. If not, we can find someone for you. But Jeff's available, jrolke@goldcoastmortgage.com. That's JROLKE @goldcoastmortgage.com. His phone number's on there, 978-922-4446. And again, more than confident, the jobs that Jeff's done for our clients have been unbelievable rave reviews. So appreciate him being here. He's been a great resource. He's even taught me 1 or 2 things today. I hope we taught you something as well. I want to be respectful of your time. I know we're a couple minutes over here. Jeff, did you have anything you wanted to add in closing?
That's it. Make sure you've got a good team around you when you go to buy or sell, and you'll succeed. Just have the goal in mind. So thanks for your time, Dave, and appreciate it.
Thanks very much. We look forward to seeing you on the May webinar. Take care.